Good afternoon, everyone. My name is Jaime Alonso Restrepo, and together with my classmates Antonio Jaimes Lozano and Jorge Orlando Gutierrez, we are going to address issues corresponding to the conceptual frameworks for financial reporting issued by the International Accounting Standards Board. Within these frameworks, important points are established, such as the objectives of the financial importation for this decision making with a prospective and plain vision, as well as the scope of this, the importance of the information being relevant and faithful, elements of the financial statements with their respective definition, recognition and derecognition, factors to consider when selecting a measurement basis, and finally the presentation and disclosure of the financial statements. Why is the framework useful? First, because it provides useful and intuitive information for investors, lenders, and other creditors for administrative, financial, tax decisions, among others. According to the board, the conceptual framework is a practical tool to help develop standards. The new improvements and adjustments that have been made are related to three main points. 1. The measurement. 2. Presentation and dissemination. 3. The recognition. Each of these points will be described in the presentation. Chapter 1. The objective of financial reporting. As I said before, the importance of financial information lies in the fact that right decisions can be made to achieve the proposed objectives. So, to put it clear, the objective of financial information is divided in three main points. Number 1. The decisions that are made regarding purchase, sale, capital rent, etc., to grant or zero loans and other forms of credit, both of influence management actions. Number 2. In order to make one of the decisions outlined above, users must evaluate the prospect for the future and the management of the entity's resources. Number 3. Finally, in order to do the above, information is required on the entity's economic resources, claims against the entity, and change in those resource claims, as well as the efficiency and effectiveness of management in discharging this responsibility in the use of economic resource of the entity.
Good afternoon, my name is Anthony. I'm going to talk about some chapters that are pretty interesting. So I'm going to take the chapter 3, 4, and 5. First of all, I'm going to begin with the chapter 2. The chapter 2 is the qualitative characteristics of useful financial information. So as you know, there are several relevant characteristics in the financial information, such as comparability, verifiability, opportunity, and understandability. However, we must highlight two more: relevance and faithful presentation. First, we talk about the relevance of information, that is, information with predictive or confirmatory value. Second, a faithful presentation to the greatest extent possible, that is complete, neutral, and error-free. A faithful representation is affected by the level of measurement, uncertainty. Cost restriction means the benefit of providing the information should justify the cost of providing and using the information. Some final considerations of the chapter number 1 refer to the prudence in the handling of financial information and the uncertainty of measurement that may arise. Now we are going to go to the chapter number 3. Chapter number 3, it is the financial statements and the reporting entity. So what we have here? This chapter describes the purpose and scope of the financial statements and provides a description of the reporting entity. The reporting entity may be part of a larger entity or may have several joint entities, and the financial statements are those that provide information on the assets, liabilities, equity, income, and expenses of the reporting entity. Within the financial statements, we can find the consolidated, unconsolidated, and combined financial statements. An important issue in this chapter is related to the limits of the reporting entity. Determining that limit is difficult, especially if the entity is not legal. In such cases, the limit is determined considering the information needs of the users of the entity financial statements. Now we go to the chapter number 4, that is the elements of the financial statements. We will define the 5 elements of the financial statements, or in this case we have 5 of them. First of all, it is an asset. So what is an asset? It is a present economic resource controlled by the entity as a result of past events. An economic resource, it is a right that has the potential to produce economic benefits. Second, a liability, a present obligation of the entity to transfer an economic resource as a result of past events. An obligation is a duty or responsibility that the entity has no practical ability to avoid. Income, increases in assets or decreases in liabilities that results on increases in equity other than those relating to contributions from holders of equity claims. That is the number 3. Now we go to the number 4, that is the expenses, decreases in assets or increases in liabilities that result in decreases in equity other than those relating to distributions to holders or the offers of equity claims. Yes, so basically that are the expenses. Although income and expenses are defined in terms of change in assets and liabilities, information about income and expenses just as important as information about assets and liabilities. So that it is about the chapter number 4. Those 3 chapters are very important, and in this video we was able to take a look into those 3. So thank you and have a good day.
Continue with the recording, and the chapter 5 is about recognitions and derecognitions. In this chapter, we will analyze the concept of recognition and derecognition. Recognition is the process of capturing for inclusion in the statements of financial position or the statements of financial performance an item that meets the definition of an asset, a liability, equity, income, or expense. Recognition have 2 important criteria. The first is the relevance, and the second is the fearful representation. Each of them have significant effects on the entity and on future decision making. And the recognition is the removal of all or part of a recognized asset or liability from an entity's statements of financial position. This usually occurs by, first, for an asset, that it's when the entity lost control of all or part of the recognized asset. Or second, for a liability, is when the entity no longer has a present obligation for all or part of the recognized liability. In the chapter 6 is the measurement. It's an historical cost measurement base. Historical cost provides information derived from the price of the transaction or other event that results in the item being measured. And other is the historical cost of assets. And this cost is reduced if it deteriorates. And other is the historical cost of liabilities. This increase if they become burdensome. Okay, and continue is the current value measurement base. The current value provides other information to reflect the conditions on the measurement date. This include fair value, value in use for assets, and fulfillment value for liabilities, and current costs. The factors to be considered when selecting a measurement basis are relevance and fruitful representation, because the aim is to provide information that is useful to investors and lenders and other creditors. And continue. Other is factors to consider in selecting a measurement basis. And the first is relevance. This implies characteristics to the asset or liability and contribution to the future cash flows. And the second is a fruitful representation. It's affected by measurement inconsistency and measurement uncertainty. In selecting a measurement basis, it is necessary to consider the nature of the information in both statements of financial position and statements of financial performance. The relative importance of each factor to be considered depends upon the factors and circumstances of individual case. In the chapter 7 is the presentation and disclosure. This final chapter is intended to guide people on how to include income and expenses in the profit and loss statements and other comprehensive income. For that, we will divide in three. The first is the statements of profit or loss. The second is other comprehensive income, and the third is recycling. The first is essential to obtain information regarding the financial performance of the entity or income and expenses and include debt. The second refers to the exceptional circumstance may decide to exclude from the statements of profit or loss, income or expensive, and from a change in current value of an asset or liability, and include those income and expensive in other comprehensive income. The board may make such a decision when doing so would result in the statements of profit or loss providing more relevant information or a more faithful representation. The third, principal income and expense included in other comprehensive income in one period and recycled to the statements of profit or loss in a future period when doing so results in the statements of profit or loss provide more relevant information or more faithful representation. When recycled does not result and statements of profit or loss provide more relevant information or a more faithful representation, the board might decide income and expensive income in other comprehensive income are not to be secondary recycled. And important information is the effective communication of information in the financial statements makes that information more relevant and contributes to the faithful representation of asset, liabilities, credit, income, and expenses. Okay, thank you very much.